Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Marvell Technology.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we get into today's stock, here is a useful tool for traders who want a more structured chart setup. VIP Algos is built for TradingView and gives you access to premium AI-powered indicators, clean visual alerts, market structure tools, risk-to-reward planning, beginner-friendly education, setup support, and a private members community, starting as low as $9 per month. If you are trying to improve how you read charts and manage trade ideas, VIP Algos can help make the process easier to understand across markets like stocks, forex, gold, indices, futures, and more. But please remember, trading is risky. VIP Algos is for education and chart analysis only, not financial advice. It does not place trades for you, manage your account, or guarantee results. Always manage risk, do your own research, and never trade money you cannot afford to lose. This is an affiliate link, so I may earn a commission if you use it, at no extra cost to you.
All right, so picture this. You're deep in the middle of nowhere, and there's this massive windowless concrete warehouse. I'm talking the size of like 3 football fields.
Right, a total brutalist fortress.
Exactly. And inside, it is so loud you literally need industrial ear protection just to walk the floor. You can feel the heat coming off these giant cooling towers, and you look up and there's just miles and miles of thick cables running along the ceiling.
Yeah, that's the cloud right there. People think it's invisible.
I mean, they do. But this isn't some 19th century factory. It's the physical reality of the internet. And right now, inside these specific buildings, the entire artificial intelligence revolution is, it's basically slamming face first into the absolute limits of the laws of physics.
It really is. We tend to talk about AI as if it's weightless, like it's just algorithms and neural networks kind of floating in the ether.
Right. Magic computer dust.
Yeah, exactly. But the reality is that this entire digital economy rests on heavy metal, just incredibly dense hardware. And that physical reality is where the single biggest bottleneck in this whole AI boom has suddenly emerged.
All right, let's move into the wealth building context, because for you listening, understanding this bottleneck is exactly how you find the massive opportunities.
Oh, absolutely. And that brings us to Marvell Technology. They are the company basically solving this physical bottleneck. It's paying off. I mean, the stock has surged an incredible 130% this year alone.
Which is wild. It's essentially the ultimate pick and shovel play. They aren't trying to build the next, ChatGPT.
Right. They're laying the physical tracks that allow it to run and charging a massive toll for it.
Now let's look at the fundamentals, because before we care about stock prices, we really have to look at the literal cables connecting these servers.
Yeah, so the central conflict for the whole industry right now is this war against a material we've relied on for like over a century, copper.
Just standard copper wiring.
Exactly. Copper has been the undisputed gold standard for transmitting data inside data centers forever. I mean, it's cheap. The supply chain is deeply established everywhere, and electrical engineers know exactly how it behaves.
It's dependable.
It is, until you get to AI. The architecture of modern AI just completely breaks the traditional copper model.
I assume that's because of the sheer scale of the calculations, right? Like if I'm prompting a massive large language model, I'm not just asking one single server blade in a rack to do the work.
Right, no, not even close. The system requires thousands of processors to work on your problem simultaneously, which means they all need to share these mind-boggling amounts of data back and forth constantly in fractions of a microsecond.
So the processors literally have to talk to each other across the room.
Exactly. That parallel processing is the defining feature of AI training. And to hold all those thousands of linked processors, data centers have evolved into what the industry calls hyperscale facilities.
Okay, hyperscale. Like an Amazon or Microsoft building.
Yeah, where a standard regional bank might have a data center with a few hundred servers, a hyperscale facility has tens of thousands of servers. They require hundreds of megawatts of power.
Wow.
And as the physical footprint of the building expands, the physical distance between, say, server rack A and server rack Z just stretches further and further.
And if those processors aren't getting data fast enough from the other side of the warehouse, they just sit there idle, right?
They do.
Which means you are burning millions of dollars in electricity to power chips that are just waiting for a file to load.
Exactly, which is a nightmare for these companies.
Yeah.
And here is where the fatal flaw of copper emerges. It happens right around the 10-meter mark.
Just 10 meters, that's what, like 30 feet?
Yeah, right around there.
Yeah.
As these hyperscale connection distances go past 10 meters and you're trying to push the massive bandwidth that AI requires, copper physically fails.
Really, it just stops working.
The electrical signal degrades heavily. The resistance in the metal generates way too much heat, which then means you need even more cooling infrastructure, which draws more power. Ultimately, the data literally cannot move fast enough through the metal. Copper hits a hard physical limit.
Wow. So if copper is basically a dead end at 10 meters, the industry has to abandon electricity for data transmission entirely. They have to pivot to light.
Yes, fiber optics. The entire ecosystem is going through this massive forced transition to optical interconnects.
So they take the data, translate it into photons, and just fire those pulses of light down a glass fiber.
Exactly. Because light doesn't suffer from that same signal degradation over distance. It doesn't generate electrical heat in the cable, and it can carry vastly more bandwidth.
But wait, the processors themselves still speak electricity, right?
Right.
Like an NVIDIA GPU doesn't run on photons. It computes with electrical pulses.
Right, the computing is still electrical.
So there has to be some kind of physical bridge between the electrical chip and the optical cable. Something has to sit in the middle and act as a translator.
And that translator is exactly where Marvell Technology has built its empire. The specific piece of hardware is called an optical DSP, digital signal processor. And Marvell essentially dominates this niche. While rivals like Broadcom were sort of pivoting their engineering resources toward other next-generation networking protocols, Marvell just doubled down on DSPs.
Smart move.
Very. They're actually projected to capture over an 80% market share in the critical 800G DSP market.
Let me see if I can visualize the mechanics of this translator chip. It's like, okay, imagine taking a really dense 1,000-page book written in English. That's the electrical data.
Okay, I'm with you.
And you have a machine that simultaneously reads it, translates it into Braille, and feeds it into a completely different medium at the speed of light. The DSP is that engine doing the active real-time conversion without losing a single syllable.
That captures the complexity perfectly.
Yeah.
Because translating billions of bits per second from an electrical domain into an optical domain completely error-free is just a staggeringly difficult engineering challenge.
I can't even imagine.
And because Marvell solved it so efficiently, they're operating as this ultimate toll booth. They aren't building the high-speed trains, they're manufacturing the tracks.
And the financials backing up that toll booth are massive. I was looking at the numbers for fiscal year 2026. Marvell hit $8.195 billion in revenue. That's a 42% year-over-year increase.
Massive growth.
And a huge chunk of that is coming from a very specific segment, which is custom silicon. That business basically exploded from $0 to $1.5 billion in a single year.
Yeah, custom silicon is perhaps their most vital growth engine right now.
Yeah.
Hyperscalers just aren't satisfied with off-the-shelf chips anymore.
They want bespoke hardware.
Right. And Amazon or Google wants a chip designed specifically for their unique proprietary server architecture so they can squeeze out every possible drop of efficiency.
Makes sense at that scale.
So Marvell provides the foundational intellectual property, like their optical DSPs, and then works directly with the hyperscaler to bake that tech into a custom-designed piece of silicon.
Which explains the hiring surge. They increased their headcount by nearly 23%, up to 6,666 employees. I mean, you don't scale a highly paid engineering workforce by almost a quarter unless you have a multi-year order backlog to justify the payroll.
Exactly. You need visibility into future revenues to hire like that.
But wait, I have to push back on this monopoly narrative for a second. We're talking about the semiconductor industry, which is flush with literally the deepest pockets on Earth.
Sure.
So if I'm a hyperscaler spending billions on infrastructure, why don't I just build my own optical DSPs? Why let Marvell take a cut?
Well, the barrier to entry isn't just capital, It's the sheer time required to develop the specialized IP. Designing a functional 800G DSP, meaning it handles 800 gigabits per second, takes years of iterative testing.
Yeah, you can't just buy time.
Exactly. But the even deeper moat is the switching cost. For a hyperscaler, the risk of deploying an unproven optical chip is catastrophic.
Because if it breaks...
If your custom internal interconnect fails, your entire billion-dollar data center goes dark. The cost of switching away from Marvell isn't just the R&D budget for a new chip. It is the existential threat of system-wide downtime.
Oh, wow. So once Marvell's architecture is validated and baked into a data center, the customer is effectively locked in.
They are completely locked in.
That brings us to the catalyst timeline, because having this impenetrable moat creates a very specific financial reality. Wall Street is completely aware of this dominance.
Oh, they are hyper-aware.
So with that in mind, there's a massive impending catalyst, their Q1 fiscal year 2027 earnings report on May 27th. And the consensus estimates are huge, projecting $2.4 billion for the quarter.
Which is up 26% year over year. Analysts have been aggressively revising their targets upward. Major institutions like Citigroup and Stifel are setting price targets well above $210.
But the data point that really caught my eye regarding this earnings report is what the options market is doing. It's pricing in a 13% implied price swing post-earnings.
Yeah, that is a massive implied move.
Just to make sure we're clear on the mechanics here. An implied options move isn't just an analyst throwing a dart at a board, right? It's a strict mathematical calculation.
Exactly. It's based on how expensive the options contracts currently are.
Right. So the market makers are looking at the huge premium buyers are willing to pay for both calls and puts, and deducing that a violent double-digit move is pretty much guaranteed.
You've got it perfectly. The options pricing indicates that institutional money managers are just terrified of being on the wrong side of this earnings release.
I mean, a 13% move on a company with a $170 billion market cap, that is a seismic shift in value for a single trading session.
It's billions of dollars changing hands in hours. But the context here is Marvell's historical track record. They've actually exceeded the options market's implied move in 5 of their last 8 quarters.
Oh, wow. So the algorithmic funds and the momentum traders look at that history and bet that Marvell is going to aggressively gap up again. They expect a massive beat.
Right, and the speculative rumor mill is just pouring gasoline on that expectation right now.
Let me guess. Supply chain leaks.
Exactly.
Yeah.
The semiconductor space is notorious for leaks. Currently, there's heavy unconfirmed chatter about Marvell finalizing new custom silicon designs for Google, alongside whispers about an accelerated production schedule for Amazon's Trainium 3 chip.
So if management so much as hints at these developments during the call,
That 13% implied move easily resolves to the upside.
now let's pivot to the chart, because this momentum is setting up a really interesting technical picture. The stock is operating in a total pressure cooker right now.
It really is. It's up 130% year to date, recently trading right around $196.
Which means it's brushing right up against its all-time high of $198.40.
Right, so we are essentially in blue sky territory here. There's no historical overhead resistance to act as a ceiling.
But, and this is the flip side, it also means virtually everyone who bought the stock over the last few years is sitting on massive profits.
Exactly.
Which means they could decide to cash out and take profit at any moment.
It creates a really tense dynamic.
So what does market sentiment look like? Because to truly understand the forces acting on this stock, we actually have to pull the lens all the way back.
We do. We have to look at external macroeconomics.
Right, and this is where it sounds almost like a conspiracy theory. We're tracing a line from geopolitical events directly to Marvell's stock price. Why would a company making optical hardware in California care about the price of a barrel of oil?
I know it sounds abstract, but it's actually a rigid mechanical chain reaction that dictates the flow of global capital.
Walk me through it.
Okay, let's trace the links. The first link is the Middle East. If geopolitical tensions de-escalate, specifically ensuring the safe passage of commercial shipping through the Strait of Hormuz, the global oil supply chain stabilizes.
Right, and stable supply means the price of crude oil drops.
Exactly. The second link is inflation. Energy costs are the baseline for almost everything in the economy. So when oil prices fall, manufacturing gets cheaper, shipping gets cheaper, and consumer inflation finally begins to cool down.
Which brings us to the third link, the Federal Reserve. Because if inflation cools, the Fed doesn't have to fight it as aggressively. Like right now, there's a greater than 77% chance of rate hikes by April 2027 because inflation has been so sticky.
Right, they use high interest rates to basically hit the brakes on the economy.
But if cheap oil hits the brakes for them, the Fed can pause those hikes or even begin cutting rates.
And that leads to the final, most crucial link for Marvell specifically, the discount rate.
Ah, the discount rate.
Yeah. When an institutional investor values a high-growth tech stock, they aren't just looking at the cash the company makes today. They're building complex financial models projecting the billions of dollars the company might make 5 or 10 years from now.
Right, let me try to break down how they value that future cash, because this is where the math gets pretty brutal for stocks.
Go for it.
If I'm an investor, $1 you promised to give me in 2030 is worth less than $1 in my pocket today.
Nah.
Because if interest rates are high, say 5%, I could just put my current money in a risk-free savings account and guarantee a return. So to convince me to buy a risky tech stock, The future earnings of that company have to be deeply discounted to make up for the guaranteed money I'm giving up.
That is exactly it. The higher the interest rate, the heavier the discount applied to those future earnings. High rates mathematically crush the present value of a growth company.
But if the Fed starts cutting rates because inflation cooled, because oil got cheaper, that discount rate shrinks.
Yes. And suddenly, all those projected billions in future AI chip sales look vastly more valuable on the spreadsheet today. Lower interest rates act as absolute rocket fuel for growth stocks.
The valuation multiples expand rapidly.
They do. So the safe navigation of oil tankers through the Strait of Hormuz genuinely has a direct, calculable impact on how much a hedge fund is willing to pay for a share of Marvell Technology.
That butterfly effect is just fascinating when you break it down mechanically. But it also sets up a crucial pivot for our talk today. Now let's talk about the risks. We've spent all this time constructing an incredibly bullish case. They have a physical monopoly, massive short-term catalysts, potential macro tailwinds. We have to stress test this. What happens if this flawless engine sputters?
The primary vulnerability is not their tech. It is the sheer weight of their valuation.
Right.
We established earlier that the market expects perfection. And the metric that illustrates this is their price-to-earnings ratio, or PE. Marvell currently trades at a staggering 64 times earnings.
Meaning investors are enthusiastically paying $64 today for every $1 of profit the company generates.
Exactly.
That is a massive premium over the broader market.
It's a towering valuation that leaves absolutely zero room for error. The danger of operating at a 64x multiple is a phenomenon known as multiple compression.
I want to make sure the mechanics of multiple compression make sense for everyone listening. It's like, imagine buying a wildly expensive designer jacket. You are paying a massive premium for the flawless stitching, the brand prestige, the perfect silhouette. But the second you notice a single loose thread on the cuff, the illusion is completely broken. The jacket is suddenly priced like a thrift store find.
That is a great way to look at it.
Because the fundamental utility hasn't changed, right? It still keeps you warm. But the perceived value drops entirely disproportionately to the tiny flaw.
That analogy perfectly illustrates the psychology of the market here. If Marvell releases their earnings on May 27th, and they show even a slight deceleration in their custom silicon growth.
Just a tiny miss.
Right. Or if management guides revenue for the next quarter just a fraction below that $2.4 billion consensus, the market reaction will be incredibly violent.
The boost thread is exposed.
Exactly. The underlying business might still be highly profitable, but the market will strip away that 64x premium instantly. If institutions decide the stock only deserves a 40x multiple based on a slightly slower trajectory, the share price will crater, regardless of the strong fundamental revenues.
And there are very real execution risks right now that could easily cause that loose thread. It isn't just about manufacturing their current chips. They are trying to digest some massive, complex acquisitions right now.
Yeah, integration risk is the silent killer of tech valuations. Marvell is currently juggling the absorption of two major companies, Celestial AI and XConn.
And these aren't simple tuck-in acquisitions, right?
Not at all. Celestial AI specializes in advanced silicon photonics, and XConn is building next-generation CXL switches for memory pooling, merging entirely different engineering teams, bridging distinct corporate cultures, and forcing disparate proprietary architectures to talk to each other without causing delays is notoriously difficult.
It's basically like trying to swap out the engine of an airplane while you're cruising at 30,000 feet.
Pretty much.
You're overhauling the technical foundation while simultaneously trying to meet the frantic deadlines for custom projects, like that Amazon Trainium 3 chip.
Right. And if an engineering team from Celestial AI hits a snag integrating with Marvell's legacy DSPs, the timeline slips. And if the timeline slips, that 64x multiple collapses.
But there is a silver lining here, isn't there?
There is. To maintain an objective view, we have to weigh that execution risk against the current reality of the market. The primary safety net under Marvell's valuation is the sheer desperation of their client base.
The demand side is just insatiable.
Exactly. Industry analysts highlight that the AI hardware market is entirely supply-constrained, not demand-constrained. Every hyperscaler on the planet needs these optical interconnects, and they needed them yesterday.
So if Marvell does hit an integration snag and a product launch is delayed by a quarter, they likely won't even lose the client to a competitor.
Because there is nowhere else to go. The customer just has to grit their teeth and wait in line. The lack of viable alternatives provides a temporary, artificial floor under the stock price, insulating them from minor execution missteps.
So with everything on the table, what's the final verdict?
Based on the research, Marvell earns an 8 out of 10 bullish score. They are the ultimate physical infrastructure play for the AI boom.
Yeah.
Over the long term, they are building the essential optical bridges that allow data centers to bypass the hard limitations of copper wire.
Holding an 80% market share in that space is just incredible.
It is. They are perfectly positioned to benefit from macro trends like falling interest rates. But the entry price is steep. It's a high-stakes momentum asset balancing incredible fundamental dominance against the razor's edge of a 64x valuation.
It really is a masterclass in the tension between physical engineering and financial psychology. Which brings me to a final thought I want to leave you, the listener, to ponder today.
What's that?
Well, Marvell is currently saving the AI revolution by transitioning data transmission from electricity to light. But as artificial intelligence continues to scale exponentially demanding data centers that might eventually span entire square miles, even fiber optics will encounter a wall.
That's true. Light, as fast as it is, still has a speed limit.
Exactly. It still takes time for a photon to travel a mile. So the question is, a decade from now, when AI models require data to move faster than the speed of light allows, what is the next leap in fundamental physics required to keep the system from collapsing? If you want to build a cleaner trading workflow, you can check out VIP Algos through the link below, starting as low as $9 per month. It includes AI-powered TradingView indicators, visual alerts, risk-to-reward planning tools, beginner-friendly education, setup support, and community access. Just remember, trading carries risk, no indicator can guarantee results, and every trade is your own responsibility. Use it for education and chart analysis, manage risk carefully, and make your own trading decisions. This is an affiliate link, and I may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.